Go now.
Ladies and gentlemen, welcome to today's webinar, Unlocking Opportunities in the Area of ESG Finance Investing and Sustainability. Today, we embark on a journey to explore how the elements of finance investing and sustainability intertwine, influence one another, and pave the way for a more prosperous and sustainable future. In recent years, the landscape of finance and investing has undergone a profound transformation. No longer are financial decisions solely driven by profit margins and bottom lines. Instead, there is a growing recognition that sustainable practices are not only morally imperative, but also financially prudent. Sustainability, once seen as a mere buzzword, has evolved into a fundamental aspect of investment strategy. Investors are increasingly scrutinizing companies not just for their financial performance, but also for their ESG practices. Today, we have the privilege of hearing from our esteemed experts who are at the forefront of this movement and will assist us to navigate this evolving landscape. First, I would like to welcome Professor Gaizka Ormazabal. Professor Ormazabal received a PhD in business from Stanford University, and he's a professor of accounting and control at ESE Business School in Spain. His current research analyzes the recent trends in ESG, such as corporate governance, financial regulation, and sustainable finance, amongst others. Some of his recent publications are focused on executive compensation tied to ESG performance, climate disclosure for institutional investors, and their impact on portfolio decarbonization, providing empiric evidence on the application of such trends. Next, we're honored to have Ms. Yoko Kojima from Mundi Ventures. Ms. Kojima is the head of ESG at Mundi Ventures, a Spanish-based venture capital group with global investments focusing exclusively on sustainable finance. She's responsible for the firm's ESG strategy, sustainability due diligence, ESG value creation projects, and investor reporting. Before joining Mundi Ventures, Ms. Kojima worked for a decade in sustainable finance, including impact measurement at the IFC World Bank Group, EU taxonomy at Clarity AI, M&A advisory at Deloitte, and corporate finance at Hitachi. And finally, we welcome Mr. Benne Brouwer, associate lawyer at Jones Day, Netherlands. Mr. Brouwer has extensive experience in investment advisory for institutional clients, fund structuring, and advising asset managers on financial regulatory matters, including IFMD and ESG. Together, these experts bring a wealth of knowledge and experience to our discussion, and I'm confident that their insights will provide a valuable perspective on our today's topic. Before I pass the floor to our first speaker, I would ask you to use the chat box for any questions which we will address during our Q&A session. Professor Ormazabal, the floor is yours.
Thank you very much. I'm assuming that everybody can see the slides correctly and can hear me well. Thanks, Elia, and thanks for the Amicorp, friends of Amicorp and the organizers of this event for giving me the opportunity to share my thoughts about this. So I'm gonna focus on basically recent regulatory developments in sustainability reporting, because I think that this is something that is gonna be of interest of this audience. I would start basically showing what was the regulatory map up to 2016, just to emphasize that things have changed quite a bit recently. I mean, this is just from Europe. As you can see, you have some recent regulatory developments over there. I'm not going to get into the details because my colleague Ben is I know that he's going to talk about the more in detail about this regulation. I'm going to focus rather on, well, I mean, before that, I would highlight some other developments here. I mean, you have not just this regulation in general, you also have sustainability reporting standards that are being developed as we speak, basically. You have the recent SEC's climate disclosure rule that was approved last March, and the cross-border adjustment mechanism in Europe, which also requires carbon accounting, and it's meant to enter into force in 2026. So like I say here, I mean, my objective is not to get into the details of the regulation. My objective is twofold. First, I would like to talk a little bit about the need for regulation, And then, walk you a little bit very briefly over the empirical evidence that we have on the economic consequences of this regulation. As far as the need for the regulation is concerned, I mean, here's what I would say a traditional theorem, I would say, in the economics literature, which is basically what people call the unraveling result. And this is often used to argue for the need or not of disclosure regulation. The idea is that there are certain conditions and certain assumptions under which there is full disclosure. Okay, so firms voluntarily, give all the information that they have. I mean, as you can see there, I mean, these assumptions usually don't hold in practice. But still, I mean, it is important to look at them, because based on whether these assumptions are more or less violated, so to speak, there is more or less need for regulation, right? I mean, the current context, you would say, well, is it possible that firms withhold information about ESG? So, in other words, I mean, is it possible that these assumptions that I just, or these conditions necessary for the unraveling result are not met? Well, I mean, when you look at, let's say, the demand for ESG report, which maybe we could measure by the amount of ESG investing out there, and you compare this with the supply of this information. So this is some statistics on the percentage of firms that disclose based on the TCFD, okay, so which is basically the most common, let's say, framework, to disclose ESG information. So, I mean, perhaps it's not surprising that some people think that, well, maybe there's a shortage of supply here. So, I mean, there's not as much information as we would like out there, right? So maybe there's need to introduce some sort of like mandatory reporting, right? But then this is not enough, because we also need to think about, let's say, what are the rationales of the regulation in terms of, let's say, welfare, right? So why would we need regulation? Well, we might need regulation because regulation has externalities. I mean, if you disclose information, also it's not just the firm disclosing information, is that this information is going to be used by other people. It could be used, let's say, by other investors. It could be used by other firms that might actually shape their decision making based on this information. Disclosure regulation might make sense because there are economies of scale, because there is less duplication of information production. Okay, so because there is more comparability of these disclosures, or because there is mitigation of agency costs. That means that, I mean, maybe if you disclose something voluntarily, this is not very credible, and if there is a disclosure requirement, this is actually more credible, and it actually, makes it something a little bit more solid for the consumers of this information that are investors, right? But mandatory disclosure could also have problems. It's one size fits all. I mean, it could reduce resharing. It could reduce other market participants' information production. It could facilitate collusion. And the problem with regulation is usually not Pareto optimal. I mean, there are usually winners and losers from it, right? So now, I mean, as promised, I'm going to talk very briefly about, let's say, the empirical evidence that we have on specifically on regulation on sustainability reporting. So here's a study from 2017 that looks at basically the stock market reaction to the NFRD. That was basically the initial regulation in Europe on non-financial information. And basically the finding of this study is that this didn't have a positive effect on shareholder value. Here's a very recent study that I have with some colleagues at INSEAD and Bocconi, where we look at the stock market reaction to the recent SEC rule. And we find something very similar, basically that the market does not respond positively. If anything, the reaction that we are finding is a negative one. Here is another very recent study that actually we are working on it these days. That is a stock market reaction to the CBAM. And this regulation will be implemented in 2026, but it has been already announced, right? And once again, we don't find a positive reaction to that. And interestingly, the more negative reaction is among European firms. Okay? Now, I've been talking about, let's say, the potential effect of regulation on shareholder value. Another question would be, what is the potential effect of sustainability reporting regulation on behavior, on firm behavior or investment or investor behavior, right? So here is a study from 2019 on the effect of the NFRD on basically, firms' incentives to increase their CSR activity, and they find that indeed that is the case. I mean, there is an increase in the CSR activity by firms after the passage of this regulation. Here's another study on the effect of the introduction of a mandate to disclose carbon emissions in the UK in 2013. And here is evidence, again, that the introduction of this disclosure requirement is accompanied by a reduction in carbon emissions. And this is a very recent study that I have with some colleagues here at ESE, where we look at the effect of the SFRD on the decarbonization of investor portfolios. And what we find is, this would be the differences relative to a control group. What we find is that there's a decrease in the average emission of investors' portfolio. We compare European funds with non-European funds, with a series of control groups, to give us more comfort that there's actually something different going on among the funds that are, let's say, exposed to this regulation. And this is the last piece of evidence I'm going to show is, I mean, maybe a third question about the potential effects of the regulation would be whether the regulation has spillover effects. And again, this is another recent study that we have done here at the ESE, where we basically show that the disclosure by, let's say, a client is followed by the disclosure of a supplier. We are talking about here on CDP disclosure. This is not necessarily or directly, let's say, disclosure regulation, but this sort of suggests that, I mean, if it's the case that we have a disclosure regulation, like forcing some firms to disclose, it is plausible that these firms, there will be some sort of like cascade effect, and these firms will ask their suppliers to disclose information that they're going to use for their own disclosure. So that means that it is probably the case that disclosure regulation has spillover effects. And this is the last slide I'm going to show here, just to try to stick to the time I was assigned. This would be, some sort of like summary of what I've been talking about here. This would be the summary of the evidence, or at least this is my takeaway from what we know in the academic literature. On the first question, what is the effect of sustainability reporting regulation on shareholder wealth? It seems that the answer is that, if anything, it is negative. The second question would be, does it induce behavior? And I think that we have enough evidence to conclude that yes, it actually increases ESG performance. I mean, in the form of ESG ratings, CSR ratings, or carbon emissions, or reduction in carbon emissions. And does it have spillover effects? We still don't have enough evidence of that, but I think that we have some evidence suggesting that it's probably going to have some effects. I don't know how surprising you might find this evidence, but at the very least, if you don't find it surprising, which I think that there are reasons to find it surprising somehow, but I think that you should consider at least the alternative hypothesis that this regulation has no effect because people get around it or for whatever reason, right? And what this evidence I showed you seems to suggest is that actually this evidence is consequential. So I mean things are going to happen, and I think that we need to understand these things because this regulation can actually shape the economy in one way or the other. And with this, I'm gonna leave the stage to the second presenter. Thank you very much for your attention.
Thank you, Professor. Actually, I was myself very surprised to see the findings of these surveys. Thank you for sharing this insight. We definitely need to see how we progress in improving, let's say, these numbers for the shareholders going forward, because that is the intention overall of promoting ESG into the regulatory framework and applying it into the financial industry. Building on what the professor has actually shared with us, I would like to pass the floor to Mrs. Kojima. Kojima.
Hi, Elia.
Thank
Hi,
you.
everyone. Good afternoon. Thank you. Let me share my screen. In a second.
For any questions to Dr. Gaiska, please feel free to type them into the chat box.
Great. Well, first of all, thank you so much, Elia and Amicorp, to have me on the panel. I was actually paying much more attention to what Professor was talking about, especially around the correlation with the financial performance and the ESG disclosure, because it's something that we are also paying close attention to, both from the empirical point of view, and then also obviously there are so many statistics that and studies that we can refer to. Through my intervention, I'm hoping to provide some of the day-to-day kind of window to how the GPs are managing the current sustainable finance regulatory landscape, by sharing what we do at our venture capital firm. To set a context, Mendi Ventures, we're a tech venture capital firm headquartered in Madrid, with an office also in Paris and Barcelona. We have invested in more than 70 startups so far, and we are currently managing 5 different funds and total of 500 million euro under asset management. Maybe what's unique about us is even though we're based in or headquartered in Madrid, we have 21 team members, and then in total of 16 nationalities. So we're very much international team, and each of us, for example, I'm originally from Japan. We have different colleagues from different jurisdictions, bringing startups, operators experience, or the investment banking experience, which allows us to invest globally. We currently have investment across 20 different countries. And as somebody responsible for ESG, this has been also a challenge to pay attention to different regulations, different ESG standards and sentiments in different countries. At our firm, we were founded in 2015 as a traditional mainstream VC. Although the founders have a strong belief in doing good would be also good for the business, we were not really funded as an impact VC to begin with. So when we first set out our ESG strategy back in 2022, we were discussing internally, okay, what kind of sustainability topics do we have to care about? And then I think here we all can agree that, the sustainability alphabet soup, there are so many different KPIs and standards that's out there. For example, in one of the sustainable finance startup that I used to work at, which is Clarity AI, we had an ESG module with more than 2,000 different KPIs just for the ESG impact. And so we were saying, okay, shall we take into account all the 2,000 or should we focus on something? And then we took the latter. And the lens we applied is basically so-called double materiality. So we had our internal strategy discussion to go over different topics to decide which of the topics are the most crucial for the impact on the planet and people, and then also the success of the startups and then the underlying investees' business performance. And we boiled that down to 5 different topics that's laid out on this slide. The first one being the founder to be purpose-driven. And when we say purpose, it doesn't mean that we have particular impact thesis in climate or something, but we really are looking at the founder's long-term vision to see what kind of difference they want to make in the society. The second part is ESG stewardship. sometimes we invest in companies that's pre-Series A, and then it's not really fair to ask for the entire different ESG set of metrics and performance. So we're really looking at the willingness for them to improve and then the mindset of the founders. And the third point is about the climate change awareness. And the fourth one being gender equality. Here we are especially looking at the leadership composition of the genders and also the unadjusted gender pay gap and so on. And the last piece is having a solid governance base. So these 5 are something that we've identified as material to our business and then also for the society to move forward. A little bit more in a detailed process that we have in terms of ESG integration. I wanted to break it down into 2 phases. So the first part is the pre-investment, the second part is post-investment. For the pre-investment part, we really start by scouting startups. So here we use thesis-driven approach. So we have a different sustainability mega trends that we are following. For example, one of the vertical we invest in insurtech. So we are looking at carbon insurance market as one of the thesis. And we did a deep dive on the sector. Here we are also applying exclusion policies. And in some of the controversials, for example, the gig economy is something that's a little bit controversial for us to invest in. Although we do invest in that sector, we have a particular thesis around sustainability in that sector. The second part is due diligence. Here we have 3 sustainability analysis. The first one is the typical ESG analysis. Here we're using our proprietary framework informed by SASB standard. And second part is the climate risk analysis. And then the third part is impact assessment. The climate and the impact, we only run it when the startup or the particular sector is considered material for them to consider those 2 portions. And the third part is investment. This is really the key. We're making sure that ESG is discussed at the investment committee where we make an investment decision. And here, the interesting point is we agree internally on the value creation plan. So when we find certain negative ESG risk or the positive opportunity side, then we really agree on, okay, well, what should go into the side letter agreement or what shall we put in the shareholder agreement with the companies? And then moving on to the second phase, which is the post-investment. Here we're doing the typical things like monitoring and measurement. Here we're also partnering with 2 startups that are dealing with the ESG tracking and etc. And the value creation is really my favorite. Here we work with individual portfolio companies, usually just on 1 project per year that we agreed on to improve. So what could be a typical gender diversity improvement in the senior leadership to something like, okay, let's create a sustainable product. And the last part is about exit. Here, the regulation thing will come into play because a lot of the public companies are more subject to different regulations. We're closely watching the CSRD. And for example, the corporate sustainability disclosure regulation. I think Benny can give the full abbreviation there as well. But here some of the criteria would be relevant for our portfolio companies. So we're helping them figure out which regulation for them to pay attention to. In terms of the sustainable regulation in the disclosure, we've been subject to the sustainable finance disclosure regulation. And in order for us to be compliant with it, we added 2 points, which you can see in a small tag as collect principal adverse indicators. That's relevant for the due diligence phase and then also the monitoring phase. And with the last minute, I just quickly wanted to share about our decision-making process on how to categorize our 5 different funds into Article 6, 8, or 9. which I'm not going to give the definition of it. I'm hoping that Benny can provide that later. But since we already had those 5 funds, when the regulation came in, it was automatically categorized or disclosure categorized by Article 6. We have decided to switch one of the funds that's actively investing to Article 8. And the reason why we didn't choose Article 9, for example, is that out of the conversation that we had with our investors, that having an Article 8 would already signal that we do care about the environment and social perspective. And also the fact that Article 9 still have a lot of room for us to decide what is sustainable, especially that social taxonomy is still not out there yet. And we heavily invest in social side of startups as well. So that was kind of the decision making that we had. And I will stop here, and I hope I didn't exceed the time. I will hand the mic over to Elia.
It's been perfect. Thank you for this pragmatic application of the ESG framework and its sustainable finance, and for sharing the perspectives of both the asset managers and the investors, as well as how you have integrated actually ESG throughout the investment cycle. I think it should be very useful to asset managers looking to follow your steps. Now let us turn to Mr. Brouwer for a more legalistic approach to our topic. Mr. Brouwer?
Yes, I will share my screen as well. I think, let me know. Sorry.
Yes, it's visible. Thank you. Yes.
Sorry, this is the one. So I think now you should be able to show. So I wanted to share something with you around the legal landscape. Obviously, in recent years, there have been quite a few laws in Europe that have been implemented, and I think a lot of people have been looking for the best way to implement these, but they have definitely had a huge impact on the asset management sphere. So I just briefly wanted to discuss SFDR, then taxonomy, CSRD, and then what happens if you do not comply with these requirements. As we only have 10 minutes, I will try to keep it high level and keep it practical a little bit, so it's something that can be followed by anyone. Obviously, the starting point of this all is the European push towards a greener economy, which I think a lot of people welcome, and the signing of the Paris Accord. So the first law that was implemented in this regard that really signaled the push was the SFDR, the Sustainable Finance Disclosure Regulation. What it intends to do is to increase ESG transparency of financial products, to make sure that the capital in Europe flows towards investing in sustainable investments. But also it's meant to avoid greenwashing, and greenwashing is a process whereby anyone that says they are green are not actually green, so they present themselves as greener than they actually are. So the way to do this is standardize processes. Then the SFDR applies to financial market participants and financial advisors, as well as the products that are either managed or sold by these parties. Financial market participants are, amongst others, managers of UCITS and AFIMs, with which I work a lot personally. But also banks and insurers, and financial advisors are people that are actually selling the products, such as placement agents, for instance. And a different set of rules apply to the financial products as such, also under SFDR. The SFDR works in 3 different ways. So first of all, the central theme is sustainability risks. So the SFDR requires fund managers and the other persons that are called by this to disclose on sustainability risks and the way they think about those. The same is true for principal adverse impacts of their investment decisions. And 3 is, and that's the most important one and the one that's most talked about, is the ambition that they have when it comes to green investments. And I will briefly touch upon these 3. So the first one is the sustainability risks. So basically what this means is outside in. So what this asks of fund managers is, how do you think about potential sustainability risks and the potential influence it will have on the value of your investments? And if it has a negative impact, how do you deal with those? So fund managers are required to put disclosures on this on their website and include information in the fund's pre-contractual documents, such as a PPM or other offering documents, teasers, investment presentations, things like that. Then on the second point is the principal adverse impacts. So these are impacts that your investment decision may have on the environment outside. So these principal adverse impacts are very difficult to nail down, but they are pretty prescriptive. So when you look at SFDR, but then also the level 2 legislation, it's actually spelled out what you need to do in relation to these principal adverse impacts and the way you need to report and disclose on them in your pre-contractual obligations documents, as well as your website. And there are several obligated indicators on which you need to report. And then there are also to provide flexibility for different kinds of managers and other persons that need to report on these. There's one big exception, right? If you have less than 500 employees, you don't have to do a principal adverse impact declaration. So in my experience, there are currently very little fund managers that actually do something with these PIA statements, except when you have very big organizations such as investment banks. Then thirdly, this is around the sustainability ambition. Some people have heard the terms Article 6, 8, or 9 funds. Basically, what the SFDR provides is a classification system in which you can classify your fund as either not doing anything with sustainability, being slightly green, so promoting ecological and social things, or doing sustainable investments. That's Article 9. So that's when you're a green fund. If you're an Article 9 fund, you need to actually be aligned with the taxonomy regulation, which I'll touch upon later. Article 8 basically means you promote ecological or social things, which can be very broad, right? So, for instance, I've assisted a fund manager that only did investments in companies where the CEO of the company would be a woman, or where the majority of the board would be a woman, and they opted for being an Article 8 fund. Even though they're not necessarily taxonomy aligned. So it's good to know that if you're an Article 8 fund, that's a very broad bucket in which you can actually, apply with that. So the greenwashing means you don't want to be greener than you actually are. It's also the other way around. You need to classify your fund correctly, right? So if you're an Article 8 fund, but classify your fund as an Article 6 fund, that also leads to potential issues with the regulator. So you need to really think about how your investment strategy actually applies into classifying your fund as either Article 6, 8, or 9. And a sustainable investment, that's for taxonomy. I'll touch upon that a bit later. This I already touched upon, and this is a brief overview of all of the rules that apply. Because of the time I've left, I will not go into it too much. It's just one thing is good to know is that the templates for disclosures and reporting is all dealt with in the level 2 legislation, so the delegated acts. And they're very prescriptive, so you cannot really deviate from that. It's very much the same for each fund manager or other person that applies these rules. Then on taxonomy, basically what taxonomy does is provide an overview of what a sustainable economic activity is. There have been 6 environmental objectives which are posted to the right, which are considered to be sustainable economic activities. In order to classify as sustainable under taxonomy, you need to do this, one of these 6, but you also need to make sure that you do no significant harm to any of the other items. So it's not just that you are environmental, you also cannot do harm to any of the others. And you need to meet certain safeguards. And if you comply with those rules, then you can say that your investments are sustainable under taxonomy. A lot of this is laid down in the technical screening criteria. So again, also for taxonomy, this is all very prescriptive. I won't go into this for too much detail because of the presentation, but it's very important to note that the way that taxonomy alignment, as we speak about it, occurs is actually dealt with in law. And then lastly, because I think the biggest issue with all of this is the data, because how do you actually measure that you're sustainable? So that's where CSRD is meant to help out. As the professor pointed out earlier, the NFRD was earlier, and CSRD actually amends that legislation to make sure that 2 things, there's more ESG reporting throughout Europe. So where NFRD only applies to listed companies, CSRD will broaden that significantly over the coming years. And more ESG reporting is done. Basically, this is where the information is meant to be coming from in relation to companies. Currently, this is our only large listed companies, banks and insurance companies that are covered by NFRD, but also other EU companies will join the ranks shortly. Basically, the first and second phases are this year and next year, whereby next year large companies will be included that comply with certain requirements. And then there's the next phase, the subsequent phase, which means that basically all small and medium-sized enterprises in the EU, as well as certain non-EU companies with significant EU subsidiaries, will be required in the future to report on sustainability, which I think is very important to note, because that will definitely be a large push towards a greener Europe. And that's where I wanted to leave it for now.
Thank you, Mr. Prager. You have shared interesting insight into the regulatory framework into the EU. Being quite mindful of time, I would like to start with the first round of questions to our panelists, if I may. Dr. Gaiska, the first question is addressed to you. There is a broad scope of standards and regulations issued by different bodies trying to standardize the ESG reporting and disclosures framework. Is it realistic to expect that all of these standards will at some point converge into a single framework with uniform applicability?
Yeah, well, this is a very good question. I would say it's the 1 million question. I mean, we have observed some convergence. Okay, so I mean, you know, we have many voluntary frameworks to disclose ESG information, and actually a number of them have already been consolidated. But the truth of the matter is that at the level of standards, we sort of have 2 approaches. We have the approach that we are taking in Europe by the ESRS, the European Sustainability Reporting Standards, and the approach that is being taken, let's say, internationally by the IFRS Foundation. And these approaches are, I mean, they coincide in many things, but they have fundamental differences. I mean, the European approach is based on double materiality. The international approach, which is based on SASB and is sort of like based on sort of like the US approach to the issue. It's based on single materiality. So there's a conceptual difference there that is not trivial. I mean, they're making an effort, to reconcile things and to make some sort of like correspondence between the two set of KPIs, or the two set of this disclosure or information sets. But like I said, I mean, there's some fundamental difference there. I mean, and I don't know, how this is going to evolve in the future. And I don't know how difficult it's going to be for companies to grapple with these differences, because, I mean, this is double versus single materiality. I don't think it's a trivial issue.
Definitely, I tend to be challenged as well by this, by the current status, hence my question. And this connects us to the next question, actually, to Yoko. Would you say that the funds and companies operating within Europe suffer from over-regulation as far as ESG is concerned, as compared to the respective funds and corporates in Asia, EMEA, and the US? Could this act as a deterrent for investors and asset managers to operate within Europe?
Well, thank you for the difficult question as well, or sensitive question. I wouldn't really see much negative impact of the regulation being in Europe, especially because there are so many other regulations coming up from other jurisdictions as well. And when we think about the entire sustainability or sustainable finance landscape, one of the big chunk is climate change related. And then especially around that topic, TCFD is applicable globally. I think the adoption rate is not necessarily high only in Europe, especially from the SECs. Also deciding on the disclosure regulations, and some of the, also we have investment in LATAM, and then some of the jurisdictions like Brazil and Chile are having the disclosure regulations there as well. So my view is that we're ahead, so we needed to do the cost burden like much earlier than other jurisdictions, but I think it's an inevitable wave, especially given that it's a material issue anyway.
I think Europe always tends to set the frameworks, and then everyone else follows, but we tend to bear the cost as well of such initiatives. Next question goes to Mr. Brouwer. How far are the industry participants in implementing the legislation and aligning their practices with the regulatory framework, from your experience that you've seen in your own practice?
Yeah, so I think they're pretty far along, right? Because if you look at the legislations that I actually just discussed, everybody needs to comply with those if you're in the scope of the legislation. So I think definitely there are challenges, but what I see from my clients is that there's a big push towards directing or becoming Article 8 funds or even Article 9 funds. But also reporting and everything associated with that is becoming more and more comfortable. Obviously, when SFDR was implemented, it was not very clear how people should actually deal with the rules that were imposed by SFDR, because there were not the RTSs yet. But I think over the last few years, we've greatly improved on that. So I think we're on the right way. But I also think we're starting to understand that the way that SFDR is currently made to work is not the most ideal way. So there might also be changes made in the future from learning. But I think we're on the right path.
Mm-hmm. And do you see a number of penalties being applied by the regulators? What is the current approach of the regulators for non-compliance?
That's a good question. Actually, regulators have been fairly laid back, and that's also because this is quite a big move, right? From doing nothing to all of a sudden imposing green on everyone. So I think regulators have been a bit laid back, but I think in years to come, definitely there will be a big push from the regulators to make sure that compliance is dealt with adequately. One of the things that some regulators have stated, for instance, if you do a classification as of your fund as either 6, 8, or 9, so green or greener, so you need to downgrade your fund if you don't actually comply with your classification, right? Which leads to all kinds of issues with your investors, but also with the regulator itself. So I think there's going to be a huge push in the coming years for sure to make sure that everybody is compliant with SFDR, taxonomy, and CSRD.
Yeah, we've already seen a number of penalties being applied to big organizations for greenwashing. We can touch upon that a bit later. And now on the matter of data collection, Dr. Gaisca, because you have been involved in the data collection sphere, it seems that we don't have enough data at this point to actually enable the setting of benchmarks. How far are we from the stage of collecting reliable and sufficient data?
Well, I think that this is gonna get better when we, after the new regulation gets implemented, right? So especially the CSRD, I think that this is gonna be, let's say, a flow of data for the market. So, I mean, the perception is that this is not enough. I mean, if you read the introduction of the CSRD, I mean, it's clearly stated there that they are introducing the regulation, among other things, because they think that we don't have enough information out there. That said, I mean, there is quite a bit of public information. I mean, like firms voluntarily disclose, at least listed firms voluntarily disclose quite a bit of that information. Whether that information is high quality or not is it's another question. There are also, let's say, several actors out there that collect and rationalize this information. For example, the ESG rating agencies. Right? So I think that these people do a pretty good job, sort of like collecting everything that is available out there. But again, there could be many things that are not disclosed because collecting this information is costly. And this is one, I mean, I guess the most obvious reasons why, you would not expect what I was talking about before, let's say a full unraveling, right? Or a full disclosure, because precisely, to disclose this information, you have to collect it, and that is very costly. So it is very likely that, we don't have enough information because we haven't pushed enough firms, to collect that information, and taking into account that the information is costly, and perhaps some of the patterns in returns that I was showing before, this sort of like tendency to show a negative stock market reaction at the announcement of this regulation, suggests that basically there's a cost there, and we need to think about who should internalize this cost. I mean, whether this cost should be 100% internalized by companies, or whether we could do something to alleviate this burden, right? In any case, I think that that is going to be the key sort of like factor preventing being more data out there, like this cost of let's say gathering this data, because once the data is there and is put out there, I think that in the near future, we're going to have artificial intelligence and all sorts of tools out there to gather this information, to process this information in a quick way and in an efficient way. And I think that this is going to be something important for investors.
Absolutely. I think this will determine the way forward for sure, because if we're looking for common grounds of reporting, then the data should actually be reliable, and we could depend on those sources of information going forward. We have seen that the more empirical approach by Dr. Gaisca as far as the value to the stakeholders and to the shareholders of green investments. Jakob, how would you, from an asset manager's perspective, how do you see the relationship between the corporate sustainability initiatives and the value to the shareholders? And how do you portray that, and how do you promote it within the organization?
Yeah, so I think it's interesting that SFDR came in first and then the CSRD is coming later. And I already see the difference between when we speak to our investors, who are usually larger banks and asset managers, who's asking for all the information just in case, that they need to report. Whereas we are going to talk to our startups who have sometimes only 20 people. They're trying to figure out product market fit, and they don't have anybody dedicated for the sustainability or ESG. So I see the sentiment difference there, and then that's sometimes difficult to navigate as a asset manager. I think the new CSRD should really help us to communicate with our investees and the businesses to obtain more data. One caveat, though, at least like from private market operator, is that they left out a lot of the private companies out of the scope. So only the large private companies will be subject to it, with even the grace period of 2 years. So for startups, 2 years is a lifetime. So it's a little bit difficult, but we're paying attention to some other voluntary standards that the EU is implementing for SMEs to report. So I think it's important for the regulators and the standards to also consider the SMEs because they're usually left behind. And again, the cost problem is always there, and then it's crucial for them, but they're so important for the economy.
Very good. Bene, do you see that the regulation is successful in preventing greenwashing, green bleaching? There's all these different names that have been given out to the different practices. Do you see that the legislation is currently in a position to tackle such practices?
Well, I think there's two elements to that question, which is first of all, we need data, right? Again, I think the legislation has been in place for some time now, and people have taken different approaches. Again, SFDR was implemented at a time where we didn't know how to actually make use of the legislation there. So it's a bit fragmented at the moment, and I think that we're also learning that not all of the choices that were made are the most ideal choices. So we're going to see in the future how this all works out. As you point out, there have been fines already implemented. So hopefully the system will correct itself. But there's also been voices in Europe that we should overhaul part of SFDR, for instance, as part of the consultation process. So all in all, I would say we're on the good way, but I think we're not quite there yet.
Okay, definitely so. We have a few questions in the chat box. I'll ask my colleague Francisco to read them out for us, so we can address them.
Thanks, Elia.
Welcome.
Thanks to all the speakers today for sharing your knowledge with us. First question will be to Bene. Based on the SFDR regulation, what is considered a fund? I mean, this regulation applies to all funds or only a part of them?
Actually, the laws apply to the managers of alternative investment funds, and they apply to all managers of alternative investment funds. So it doesn't matter whether you're exempt under AIFMD or not, whether you have a full license or not, and that's also guidance from the EC, European Commission, and others. ESMA have been very clear on the fact that all managers of alternative investment funds, whether regulated under AIFMD or not, need to comply with these rules.
Okay. One question for Professor Ormazábal. That's a big paradox. One of the questions that was raised. For instance, the European Union is promoting, because of this situation that we have in Europe, defense investment in army and defense technology. But at the same time is promoting ESG values. How this paradox can be explained?
Yeah, it's a really good question. I mean, I wish I had the I mean, I guess, in all this, let's say, movement towards a greener economy or a more sustainable economy, there's a big trade-off, and I guess that this question is connected to this. There's the trade-off between, or it's the question of whether we're going to be able. I mean, what could be convinced, and I think that probably most of us are convinced that. I mean, if we promote ESG or sustainability, I mean, the future is going to be better. The long term is going to be better. But the problem is that we need to get to the long term, and there's a short term, and there's a medium term, right? And the problem has been, what I've observed out there is that firms or investment funds that they position themselves as ESG, but they don't deliver financial results. I mean, sometimes the end of the story is not quite happy. And I think that might apply to our society in general, in the sense that it is very likely that, I mean, if we move in this direction, we are going to be better off in the long term, but we need to get to the long term, right? So I think that this defense issue is just one example of many of the sort of like trade-offs that we are facing. That we want this, we want the environment, we want social justice, we want to get there, but we have to earn our wage for tomorrow, and now we have short-term problems, and a big short-term problem that we have now is the war, yes, right? And you have to deal with that somehow, and then you have to make trade-offs and manage these trade-offs somehow. And perhaps make some decisions that are not what you would like, but it's basically what you have to do, or you think that you have to do if you're gonna get to the long term, so to speak. So I think that this is my way of explaining this sort of like paradox that we observe nowadays. But I mean, it's clearly some sort of contradiction, right? But I think that this contradiction could be explained somehow by this sort of like short-term versus long-term sort of management of things. But perhaps other people have a better explanation for that. That's
sure,
mine.
This is a good one. Sure. And one question for Yoko. Yoko, you have experience in one data provider like Clarity. There's an increasing number of ESG providers coming to the market. In your opinion, how reliable they are, and what would you recommend to fund managers to choose one or other?
Sure. At least I know that many data providers or ESG SaaS type of platforms, they have two capabilities. So one is to collect the actual data from the companies. The second one is to create an estimate. So if you're choosing a provider with the latter capability of estimation, make sure that you understand how they're doing the estimation. Because, for example, in our case, it's very important to have a broader geographic benchmarks. Otherwise, we cannot really compare the gender diversity of Europe to the one of the LATAM. So those small nuances are important. What we're doing to make sure that the data quality is kept intact is really to have the communication with the founders. So at this point, it's we use the data tools and we collect them, but it's a human and machine kind of situation where we use a machine for the validation, but then at the end of the day, we have a day-to-day communication with the founders. So I hope that answers the question.
Pago, you're on mute. There is, I think, one more question.
Thanks, Yoko.
Thank you.
Yeah,
what
there's
happens
one more.
If,
yeah, sorry.
Yeah, what happens if an IFM opts not to market any ESG compliant products? Maybe that goes to Yoko again, or whoever. Yes, Benne, you want to take this up? Yeah.
Yeah, sure. Nothing. Right, you can choose to not market any ESG friendly products, but then you need to disclose to your investors that you're not doing that, and that's the issue, right? Because a lot of investors will have a sustainability ambition themselves, and they only want to invest in Article 8 or 9 funds. So if you're in Article 6 funds, not doing anything ESG friendly, then you might have an issue raising capital from investors.
One more question. There is a huge variation in the availability of ESG data and also lack of regulation, standardization in emerging markets. However, in these markets, there are opportunities for investors. How fund managers measure these risks and how ESG criteria are integrated in the portfolio they manage? Any volunteers? Sounds like a complicated question to tackle.
I can give it a try because we are very bullish on also investing in the emerging market. It's true that the data quality and the general standards for governance might be different especially from Europe. But I think if you're an investor and trying to make an impact in those emerging markets, there are other tools such as the impact management platform, mostly coming from more philanthropic capitals, and the development finance institutions have very rigorous framework there as well. So I think we can probably opt into those standards and development rather than using the ESG lens. Obviously, in the end, probably those two would emerge or at least come close. But I think there are other tools that we can also leverage to make sure that at the end of the day, we're using those data to really evaluate the company as is. So I think we also have some tools there.
Being conscious of time, I think we'll pose our last question at this point. And I would like your personal take on this one. What advice would you give to young investors who want to prioritize sustainability in their investment portfolios? I would like the views of all three of you.
Maybe I can start.
Please go ahead. Yes.
Okay, so I would say be creative to deliver reasonable returns, and or explain very well what is the cost. I think that there is more and more people nowadays that are willing to accept lower returns because they care about things that is not just returns or money. But I think this needs to be explained very well. I would say, from a logical perspective, if I compare, let's say, an ESG fund and a fund that has no constraint, one would expect that the returns of the fund that has no constraint are going to be higher. But I'm not sure whether this is necessarily true, but that could be okay, because basically, like I said, there are people that don't care only about returns. But these people, everybody cares about their money. So these people might need, a very clear explanation for why this return is lower, or a clear explanation for basically, the how, let's say, this other value is being created somehow, right? And I think that everybody should be able, to deliver some sort of minimum return, because below that minimum return, I think that we're going to start getting into trouble in this sort of short-term versus long-term kind of trade-off that I was talking about before.
Thank you, Dr. Gaiska. Yoko, you want to go next?
Yeah, I fully agree with what the professor said, and that's why we really focus on double materiality. I think that the advice would be probably not to try to do everything at once. There will be steps. So my suggestion is to start with the minimum safeguard. So what's the minimum? What will get you into a trouble if you don't do? And then the second part would be to really focus on the double materiality of your fund. Depending on if you're a green fund, obviously the CO2 emissions or those things will be more relevant than others. And if you're a tech company, tech fund, then it will be more about ethical AIs and governance. So I think the materiality is slightly different depending on the fund's focus. So that would be my advice.
Thanks, Jakob. Bennett?
Yeah, I think to end then, do your due diligence well. If you want to do an investment into a company, really understand what their business is. And, if you want to invest in a fund as a fund investor, make sure that you really understand the disclosures, because they are template based to a large extent, and they're not always intuitive to a certain extent. For instance, nuclear energy is also considered to be green under European laws. So it's very good to really understand what you're investing into and make sure that you do your diligence in this regard.
Thank you, Bene. I would like to thank our distinguished guests and speakers for their engagement and insights into sustainable finance, investing, and ESG, and of course our audience for joining us today and enriching the discussion with their active participation. Our today's discussion has shed light on the importance of finance, investing, and sustainability, and how these forces are interconnected, shaping a more equitable, resilient, and sustainable future for generations to come. Thank you all for joining us today.
Thank you.
Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you. Bye.
Bye-bye.